Please hit that subscribe and like buttons. Boeing's struggles and the global manufacturing slowdown, a sign of tough times ahead? The recent announcement of Boeing's decision to cut 17,000 jobs and delay the 777X jet reveals much more than an internal crisis within one of the largest aerospace manufacturers in the world. It is a reflection of deeper economic tensions, exacerbated by a slowing global economy, rising inflation, and labor strikes. While Boeing's struggles are specific to its business model and operations, they also point to a broader picture of what might be looming on the horizon for manufacturing sectors, especially as economic indicators like the manufacturing PMI are showing signs of contraction. This blog will explore these complexities, framing Boeing's announcement within the broader context of macroeconomic shifts, labor market disruptions, and potential signs of recession. Boeing's cuts and delays, a deeper examination. Boeing's decision to lay off 10% of its workforce and delay the delivery of its 777X jet reflects an accumulation of internal challenges that have been brewing for some time. Between the machinists' strike that ground operations to a halt and the production issues that emerged after the 737 MAX crashes, Boeing has been navigating turbulent waters for years. The ongoing labor dispute has particularly impacted the company's ability to meet production targets. With 33,000 workers striking over pay and working conditions, Boeing has had to halt production of its key models, the 767 and the 777X, compounding its financial troubles. The company has been unable to generate the cash flow it needs to address its broader operational issues, and this has only further strained supplier relationships and customer deliveries. This is not just a Boeing issue, it is indicative of the larger labor tensions we are witnessing across industries. As workers demand better pay and working conditions amid inflationary pressures, companies are finding it increasingly difficult to balance these demands with their need to maintain profitability. The aerospace sector is uniquely sensitive to labor unrest. Delays in production not only disrupt supply chains but also damage the long-term confidence of both airlines and military clients. Boeing's troubles then have ripple effects far beyond its factories and offices. The contraction of the manufacturing PMI, a warning sign. Boeing's struggles align closely with troubling trends in the US and global manufacturing sectors. The manufacturing PMI, an important indicator of manufacturing health, has been signaling a contraction in activity. This index, which tracks new orders, production levels, employment, and supplier delivery times, has been falling below 50, the threshold that separates expansion from contraction in recent months. As manufacturing slows down, Boeing's challenges reflect what may become an increasingly familiar story across industries. When major manufacturers like Boeing cut jobs and delay projects, it suggests that confidence in future demand is waning. As new orders decline, companies are forced to scale back production and cut costs to preserve margins, which often results in layoffs. This, in turn, depresses consumer demand further, creating a vicious cycle. The PMI contraction is a signal that manufacturing output is decreasing, which can lead to weaker GDP growth and, in the worst-case scenario, trigger a recession. The aerospace industry plays an outsized role in the U.S. economy, supporting hundreds of thousands of jobs across the supply chain. Any significant reduction in output, therefore, has a magnified effect on employment, consumption, and even exports, as American aerospace companies supply both domestic and international markets. The labor market plays a critical role in determining the pace and severity of economic slowdowns. Boeing's labor dispute is just one of many high-profile labor issues currently affecting major corporations. From the United Auto Workers strikes to the recent Hollywood writers' strike, labor unrest is on the rise. The source of this discontent is clear. Inflation has been eroding real wages for several years now, pushing workers to demand higher pay and better working conditions. For businesses, wage pressures come at a time when they are already struggling with higher input costs and supply chain disruptions. The temptation for companies, as we are seeing with Boeing, is to respond by reducing headcount and scaling back operations. But this can be a dangerous game. Layoffs reduce consumer purchasing power, and large-scale job cuts, especially at companies as influential as Boeing, can send shockwaves through local economies and beyond. At the same time, labor disputes put companies in a difficult position. Giving in to wage demands can lead to higher costs that are passed on to consumers, feeding into the inflationary cycle. But failing to reach an agreement can result in strikes and operational shutdowns, as we have seen with Boeing, which damages the company's ability to fulfill orders and generate revenue. The debt problem, Boeing and beyond. Another worrying sign from Boeing is the increasing pressure on its balance sheet. The company's debt load has been rising as it burns through cash to stay afloat during these difficult times. S&P recently issued a warning about Boeing's bonds potentially being downgraded to junk status, which would further increase the cost of borrowing for the company. Boeing's debt troubles are emblematic of a broader issue affecting many companies. As interest rates rise, companies that have taken on significant debt are finding it more expensive to service their obligations. This is particularly problematic for industries that require significant capital investment, such as aerospace. The more debt Boeing has to issue to finance its operations, the less flexibility it has to invest in innovation and expansion. For investors, Boeing's situation is a stark reminder of the risks associated with highly leveraged companies, especially in an environment of rising interest rates. The aerospace giant may need to raise additional equity to stabilize its financial position, but this could dilute existing shareholders, further eroding confidence in the stock. Global implications. Is this a sign of bad times for manufacturing? Boeing's difficulties cannot be viewed in isolation. Across the globe, manufacturing sectors are facing a similar set of challenges. In Europe, the energy crisis triggered by the war in Ukraine has disrupted production lines, particularly in energy-intensive industries like chemicals and metals. China's zero-COVID policy has also slowed down industrial activity, causing a significant drag on global supply chains. The U.S., while somewhat insulated from these specific issues, is still experiencing the ripple effects. As global demand for goods slows down, U.S. manufacturers are finding it harder to justify ramping up production. For Boeing, this means fewer orders from international airlines, which are themselves grappling with rising fuel costs and slowing demand for air travel. This global slowdown in manufacturing is feeding into broader concerns about the health of the global economy. If major manufacturers like Boeing continue to cut back on production and delay new projects, it could signal that we are heading toward a deeper and more prolonged economic downturn than previously anticipated. Can Boeing and the economy rebound? While the picture currently looks grim, there is hope that Boeing and the broader manufacturing sector can turn things around. For Boeing, the key will be to resolve its labor issues quickly and get production back on track. The company has significant backlogs of orders, particularly for its commercial planes, and fulfilling these orders will be critical to restoring cash flow and investor confidence. On a broader level, much will depend on whether inflation can be brought under control. If central banks can tame inflation without causing a recession, it could set the stage for a manufacturing rebound. For now, however, the focus is on navigating through what appears to be a challenging period for both Boeing and the U.S. economy. Conclusion: only time will tell. Boeing's decision to cut jobs and delay projects, combined with the contraction in the manufacturing PMI, suggests that we may be entering a period of economic turbulence. Whether this is a temporary slowdown or the beginning of a more sustained downturn remains to be seen. What is clear, however, is that companies like Boeing are facing significant headwinds, and their response to these challenges will have far-reaching consequences for the economy as a whole. For Boeing, the immediate priority will be resolving its labor disputes and getting its production lines moving again. But for the broader economy, the challenges go deeper. Rising interest rates, inflationary pressures, and labor unrest are all contributing to an increasingly uncertain outlook. Only time will tell whether Boeing's struggles are a harbinger of more bad news to come. As Enki Insights focuses on long-term economic trends and resilience strategies, it is crucial to monitor these developments closely. The challenges Boeing faces today may well be the challenges other manufacturers face tomorrow. By staying informed and adaptable, businesses and investors alike can better navigate the uncertainties ahead.